A wonderful evening, everyone. Thank you for joining us to our Investing Bootcamp webinar. My name is Eamon Gebre, Head of Wealth Advisor here at Sarwa, and I'm joined alongside my colleague and wonderful friend, Mr. Akshay Iyer. Maybe we should start with a round of introductions. Akshay, what do you think?
Yeah, that sounds perfect, Eamon. Thanks for the brief introduction, but an introduction to myself, everyone. My name is Akshay, as Eamon said. I am part of the advisory team here at Sarwa. I actually have a background in banking as well as private wealth management. So I started my career at the Canadian Imperial Bank of Commerce in Canada. It's also where I was educated. And following that, I worked for a British private wealth management company. So I've actually been with Sarwa now for the past year and look really passionate about what we're doing here in terms of democratizing investing, but really bringing across, much more flexible, transparent platform to this region. And it's very passionate about financial education and financial wellness. So that's why I'm really thrilled to be joined by Eamon with me today to conduct the session. But yeah, thank you.
Thank you for that, Akshay. And again, my name is Eamon Gebre, Head of Wealth Advisory at Sarwa. I've been with the organization, just celebrated my 2-year anniversary, so they haven't gotten rid of me yet. And not to jinx it or anything of that sort, but I've been in the region approaching 12 years, and it's been an amazing journey, an amazing ride, a place that I call home. Spent much of that time with HSBC, working in their retail banking and wealth management division. I've also spent 10 years working in Canada for a bank called TD Canada Trust. My entire career has always been having these types of conversations, giving guidance to clients, support to help them achieve their financial goals. I'm a big advocate of financial planning, even to the point of annoyance, to my friends. But I'm here to kind of just share with you best practices on how to help you achieve your financial goals. Today, as I said before, the title of our webinar is called Investing Bootcamp, where we're going to be talking about the best practices when it comes to investing. Rules, for another way to describe it. So there's 4 key rules that we're going to be highlighting, and we welcome any questions that you may have. There is a question box on Zoom that you can type in your questions, whether you want to add your name or whether you want to ask the questions in an anonymous fashion. Either way is acceptable. We will be addressing them towards the end of the presentation. So without further ado, Akshay, shall we start?
Yes, let's do it.
Let's do it. Amazing. Now, it's important to kind of get the legalities out of the way. I want to make sure that everybody who in attendance today does understand that the views that we're taking or the views that we're going to be sharing today should not be interpreted as one-on-one financial advice. This is really important because each and every one of us have unique circumstances, and it does require more of a bespoke approach to give you advice on the individual level. So in that sense, speak to your financial advisor or speak to one of ours, and we'd be more than happy to give you guidance for your unique circumstances to help you achieve your goals. And secondly, we do not have a crystal ball. We can't predict the future. So if you have any questions about what's going to happen in the market tonight, what's going to happen in the market a week from now, unfortunately, I don't have the answer. And anyone that does, I would be very wary of the advice that they're going to give you because the stock markets are not something that you can predict in the near term. There are best practices that you can take to help you improve your chances of positive performance, but you cannot dictate and predict what the returns are going to be in any particular sector or asset or stock for that matter. So let's start maybe with giving a little bit of an overview, especially for those who just recently joined Sarwa as a new client of ours. Wanted to highlight that we were the region's first digital financial services company. And what that means is that we took the traditional business model that you would see at a bank or with a wealth advisory firm, and we've digitized it. What that means is the onboarding journey is digitized. You can download and register to open an account from the comfort of your living room or the dining room table, or some clients, I've seen them even do it in their offices as well. We will manage your portfolio in an automated fashion. In addition to that, we still give you strong customer support and advisory support along your journey. So it's not just robots behind the scenes kind of, pulling levers up and down. We offer 3 key services here at Sarwa. We offer Sarwa Invest, Sarwa Trade, and Sarwa Crypto. And what that essentially means is that if you're looking for a service in which we are going to provide you a recommendation on where to invest your money and you want someone to manage it for you, Sarwa Invest might be the ideal solution for you. If you're looking to kind of, have a more DIY approach and be behind the driver's wheel of picking and choosing what you'd like to invest in, Sarwa Trade might be ideal for you. And for those who are crypto fanatics, if you're looking to invest into crypto and you're looking for an entry point, Sarwa Crypto would be a really great solution for you as well. Our aim, when we opened our doors back in 2017, was to democratize investing. by offering cost-effective, transparent, and easy-to-use investment solutions for investors. Since 2017, we've grown considerably. As I said, when we first opened our doors, we were Sarwa Invest, and then we started adding more product lines in order to meet the needs of our customers. And since then, we've become, not only were we initially regulated by the DFSA, but we're also now regulated by the FSRA, and our list of partners and shareholders include Mubadala, the DIFC themselves, and Shuruk, just to name a few. Now, the challenges that many individuals face within this region, and fairness to say, Akshay and I have worked in other markets around the world. I would say it's probably more of an international challenge more than anything else, is that many of us don't have great money management habits. It isn't something that's taught to us when we're in primary school or high school or even university for that matter. We went on to become amazing engineers and doctors and great financial analysts, but we've never learned as to how to generate wealth and how to manage it, even if we should achieve it. And many individuals, unfortunately, don't know where to start. They think maybe I should go to YouTube and maybe follow some guru that tells me what I should be investing in. Maybe I should read some books. But more or less, a lot of us feel stuck and don't exactly know where or how to start. And for those who are brave enough to actually take that step forward, they've identified that a lot of the solutions that have been presented to them, and I'm using the word presented in a very loose manner, tend to be very expensive, overly complicated, and at times very restrictive. Akshay and I have seen, investment plans in which there's an expectation to be locked in for a period of up to 25 years. And what happens if you should exit from your investment is that you suffer a penalty, which is quite considerable, even to the point that your principal is pretty much diminished. It's very difficult, folks, to plan for 25 years in advance and keep to that commitment, because life will just throw surprises in your direction. Your circumstances will change, and you need that flexibility to be able to adjust accordingly. I can't even predict what I'm going to have for dinner, but let alone predict what I'm going to do for the next 25 years. So this is what a number of clients, unfortunately experience when they try to set out and find investment solutions for them. We tend to procrastinate as a result, since we can't find the right ideal solution. And what tends to happen is that we suffer as individuals. We end up finding out that we have not saved enough for our goals. Very common goals, such as a retirement pot, such as saving up for the dream home that you had in mind, saving up for our children's education, end up scrambling to try to meet those needs at that point in time. This is a commonality. In fact, there was a survey that was done by Mercer that identified that 61% of the people in the UAE do not have any long-term savings at all. And this is where one of our pillars at Sarwa is to educate our clients on the best practices to help them achieve their financial goals by teaching them, ways that they can mitigate against these barriers to entry that is all around them. So we're going to jump right in. This is a little bit more of a, prelude into the 4 rules of investing, but we're going to jump into the very first one, which is rule number 1, start now, yesterday, if possible. Kind of a back to the future scenario here, if anybody gets that reference on the call today. Start now, as early as possible. You are the greatest benefactor by starting as soon as possible. Well, why is that? Well, I want to start by sharing a quote by Robert G. Allen, a famous investor, also author, who was quoted as saying, "How many millionaires do you know who have become wealthy by investing in a savings account?" I rest my case. And it sounds very, tongue-in-cheek, but the reality is you're right. How many millionaires do we know that have done such an amazing job just by investing in a savings account? Not many, not any, if for that matter, right? Well, the reason being is that when you save money in a savings account, typically it's eaten away by the cost of living or the inflation rate every single year. In fact, inflation historically has ranged between 2 and 3%. Through good times and bad times, the average inflation rate is typically between 2 and 3%. If you're looking at the cost of living today, definitely feels a lot higher because it is higher. The headlines are full of news of what's happening in the US, but that also has a domino effect here in the UAE as well, where the cost of living has increased. Definitely not to the tune of what they're experiencing in the US, where they're north of 8% year on year, increase in cost of living, but nonetheless, it's a reality. Inflation is that silent pickpocket that takes money out of your wallet without you noticing. It's a little bit here, a little bit there, then all of a sudden the amount of money that you expected to have at the end of the year just doesn't seem to be enough to be able to pay for the things that you normally used to be. Well, let's take for an example an inflation rate of 2.5%. So let's just go middle of the road. $1,000 today basically isn't worth $1,000 in 10 years. In fact, it gives you the purchasing power of $720. So leaving money sitting idle in a current account and a savings account, assuming, historically the interest rates have been quite low, assuming a 0% rate of interest, your purchasing power has diminished. Things will be much more challenging for you to purchase at a later stage. Sometimes this concept is a little bit, this construct is difficult to kind of wrap a head around, but let's put real terms of common goals that our clients speak to us about, such as purchasing a home. Let's say there's a home today that's worth $650,000 on the market, convert that into dirhams, etc. $650,000 today. That same home, realistically, based on a growth rate of 3% in 10 years' time, it'll cost you $873,546 to purchase that same home. It will cost you more. University fees, very popular goal for many of our parents here at Sarwa, where they're looking to subsidize their child's education. They had the benefit of attending great schools. They want to make sure that they pass that gift on to their children. And this number that you see before you of $150,000 might seem very alarming, but that's typically the average cost for a undergrad university program in the US for a mid-tier university. $150,000 includes tuition, includes room and board, and also a little bit of spending money for the child because you want to make sure they're not eating macaroni and cheese every single night. $150,000 today, it'll be $223,695 in 15 years' time. Same goes forth for cost of living. If today your minimum requirement to live a decent quality of life is at least $5,000, well, you'll need at least $9,030.65 per month just to be able to enjoy the same quality of life. How are you going to be able to achieve this? By leaving money sitting idle in a savings account that is losing against inflation, that is losing purchasing power. Well, the only answer, folks, is that you need to make your money work harder for you. You need to make it work as hard as possible for you by investing it. Now, investing is a very general term, right? It could be applicable in so many different scenarios. We can invest in purchasing land, be investing in real estate for that matter. Maybe you would like to invest in starting your own business, or maybe investing in a pre-existing business, or maybe a new startup. There's so many different avenues that you have available to you to make your money work harder for you. What we focus on here at Sarwa and what we're passionate about is investing in capital markets. Why? Because capital markets have arguably been the best generator of wealth for individuals. If you look at the historical returns, when you look at major indices such as the S&P, the NASDAQ, the Dow Jones, and many other indices all around the world, you would have seen a meteoric rise upwards over the years. And in comparison to many different asset classes that we have as retail investors, this tends to be the greatest value for money. Well, why is that, right? Well, stocks have this unique thing in which you can benefit from capital appreciation and also dividends, okay? Capital appreciation, in summary, is just you purchasing a stock in hopes that this stock will appreciate in value. And if I was to take a real estate example, you buy a house for 1 million dirhams, you aspire for it to be worth maybe 2 million dirhams at a future date. It's the same idea with stocks as well. Where the unique thing that stocks have is that you're also paid a reward in the form of dividends for holding on to those shares. And dividends are great because you can do so many different things with it. You can either live off of the dividends or you can reinvest them back into your principal so that your money is working harder by allowing your money to make money. So it's money on top of that. This is what allows you to have growth over time. Investing your capital, reinvesting your dividends, you benefit from compounding interest, and that's how you allow your money to make money. Now, for those who are, first-time investors, it's natural to feel apprehensive when investing in the stock market. It feels almost like it's a figment of our imagination. We can't feel it, we can't touch it, we see it on our statements, but it's something that isn't like a bricks and mortar where you can actually hold on to it and say, this is my asset. And many people tend to feel that the volatility is something that's inherent to investing. Well, ladies and gentlemen, that's fact. Volatility is inherent to investing. Stock markets have randomness. They will go up and they will go down. And they will go up and down in a very irrational and unpredictable manner. One day there will be good news and the market will go up, and one day there'll be bad news and the market will go down. Also, at the same time, there'll be good news and the market will go down, and bad news and the market will go up. There are so many variables when it comes to the stock market that it will cause scenarios such as what we saw in 2008, where we saw the stock market, well, in this example, the S&P 500 plummet by about 50% when we're having a financial crisis on a global scale. That's a lot to stomach for a lot of individuals, where you're seeing your hard-earned income that was put towards investing, and you're seeing the value drop by 50%. We saw the same thing repeated in 2020, where we saw the markets basically drop by an average about 30 to 35% during that period of time, when we had the COVID pandemic, where we weren't even thinking about the stock market. We were just worried about our health and our security and our future as a society. Well, this is the reality of investing. But you see this granular view that I'm showing you, this 2008 and the 2020, quite recent, and also what we're going through today. We're seeing doom and gloom in the news and the markets on a downward slide as we see it right now. And this granular view will make a lot of people nervous. And to that I say, take a step back. Take a step back and tell me where you see 2020 in this chart. Where do you see 2008? In fact, where do you see the dot-com bubble in the year 2000? It seems to be awash, seems to be, non-existent. And that's because when you take a holistic view and take a step back, you'll realize that volatility is basically inherent to investing. However, markets generally rise upwards over the long term. This chart that I showed before you basically tracks many different, stock investments throughout the globe, and even non-stock investments as well. And what it does is it goes all the way back to 1925 and assumes you had deposited $1,000 at that point in time. And it tracks the trajectory of how that $1,000 performed through many different milestones in our history. We had the Great Depression in the 30s. We had World War II, and of course, none of us were probably around at that point in time, but it did happen, just to let you know, by the way. We had the Korean War, we had the Vietnam War, we had the oil crisis in the 70s, where inflation was through the roof. We're talking about inflation today at 8%, but there was a point in time where inflation was north of 15, close to 20%. We had the Chernobyl disaster in the 80s. We had the Gulf War, for those who were in the region at that time. Very scary time. We had the subprime crisis, or the financial crisis, in 2008. We had 9/11 just a few years before that, dot-com bubble, as I mentioned. All of these historical events happened, but yet the stock market went in one direction, upwards. This is the reason why, ladies and gentlemen, it's important to take a long-term view versus a short-term view, and basically start as soon as possible, because you want to be on that journey upwards over a period of time versus just waiting on the sidelines and leaving your money sitting idle. Now, let's talk practicalities here. So what is the best way to start? The whole idea of this first rule is about the most important thing to do is start as soon as possible, but let's talk about how to do it. We feel that the best way to start is by having a goal in mind. Something personal to you, something that you would like to accomplish, whether it be having a nest egg, by a certain age, whether you want to achieve early financial independence, whether it be funding your child's education needs, or whether it might be just having a little bit of extra money to enjoy a quality of life that you want. Whatever that goal is, prioritize it, visualize it, write it down if anything else, because it gives you something to focus on. Much like driving on the road. If you're driving, if you focus your gaze forward, you will go forward. But if you're focusing right or left, you'll find that your car starts veering left and veering right. Now, I beg you, please don't test me on this, but just take my word on it, or maybe do it in the parking lot, because I don't want to be liable if there's any accidents. But what I'm trying to say is that your focus is really important when it comes to your investing goals, because it will help inspire you to work towards them. Over my career, I've spoken to so many clients who had that initial vision, but they veered. And unfortunately, we're going in circles. And by the end of their investment tenure, they're like, I'm no better ahead because I kept on diluting myself and doing so many different things. So the most important thing is have a goal in mind, have something that you can work towards. The second thing to do is focus on reducing your debt. And this is key, ladies and gentlemen, especially when we're operating in a region in which interest rates are arguably one of the highest in the world. I received a notice from my bank the other day that said that we're raising your interest rate on your credit card from, I think it was 36% to 44% per annum. 44%. Now, thankfully, I clear my balances every single month. That's part and parcel of how I manage my, financial affairs. But there are individuals who have credit card balances and they're still aspiring to invest. Well, to that I say, well, if you look at the chart that I shared with you earlier on, and it showed this line going in one direction on a very positive route, the historical average return for the best performing market in the world was 10.4% per annum. If you're paying 44% per annum on credit card balances, it's like taking one step forward and multiple steps back. You want to prioritize your, paying off your debt, especially if it's unsecured debt. Good debt, it's absolutely fine. So if you have a mortgage, it's absolutely fine. Even if you have a vehicle loan, a vehicle is a means of production. It allows you to get to work, it allows you to come back, it also allows you to enjoy a great quality of life, and that's okay. But if we're talking about personal loans, credit cards, overdraft protection, these are expensive propositions, and you're going to find your net worth being eaten away versus growing. So do prioritize and pay them off. The third pillar, I would say, or the third, most important thing to do is have some emergency reserves. Businesses have emergency reserves. They have cash flow set aside. Your grandmother probably had a little bit of a, little money, in her purse or maybe underneath the bed, if anything else, in case of any emergencies. It's no different. It's recommended to have emergency reserves set aside, and it's okay to have it in a savings account or in a current account because emergencies can happen unannounced. They're unpredictable. And what you want to make sure is that you're not in a position that you have to liquidate your investments, not by choice, but because you have to in order to meet to meet the needs of any emergencies that should occur. We've seen this in our career. Akshay and I were individuals who were investing every single dollar that they had, but didn't leave any cash reserves. That, there's a vulnerability in that. When you do need money and you need to withdraw it from your capital investments, well, what if the markets were down then? What if they were down 50% in 2008 and you needed money? What if it was 2020 during the COVID pandemic and you lost your job and you didn't have emergency reserves? You didn't have a choice. You had to go towards your investments. That, is something that's, it's going to add insult to injury. So you want to make sure you build your foundation and build it strong so that you can grow upwards, or you can, basically, develop upwards. So assuming you have these three things under control, you have a goal in mind, you don't have, debt that you're concerned about, you have your emergency reserves built up, ideally 3 to 6 months equivalent of your fixed expenses is an ideal amount of money to have liquid and set aside. Now you could start thinking about investing. And a great way to start is any excess money that you have beyond your emergency reserve requirement. This is idle money. This is money that's unencumbered. This is money that's not promised to any other, projects that you have coming in mind. Might as well apply this towards your long-term goals and invest in it. So that's a really great way to approach it. And then you supplement it. Most of us get paid on a monthly basis within this region. Prioritize yourself and your goals and pay yourself first. So every month you make a budget of how much you can allocate from your monthly income that you can pay yourself so that you can reward yourself and basically guarantee your future self, a successful future self. So in summary, set a goal, manage your debt, have the emergency reserves, anything beyond your emergency reserves, invest it, and supplement that investment by investing on a monthly basis by making a budget. This is how you start in a summary of rule number 1. Now, is there anything that you want to add to this? Actually, I know I've kind of been talking at length, but let me know if there's anything else that you recommend we kind of touch upon on this one.
No, look, I think that was very well covered. I think really there's a reason why it's rule number 1. The importance of starting early and starting now is really the most important thing that you can do to really benefit yourself, I think, in investing. So, that's the reason why we have it as rule number 1. So yeah, that's kind of it.
Awesome. Amazing. So what I'll do now is I'm going to move on to rule number 2. And again, ladies and gentlemen, if you have any questions, curious about anything, please don't hesitate to type them into the Q&A section. We will be addressing them towards the end of the presentation. So let's jump into rule number 2. So we're on the same page. Now, you understand the importance of starting your investment journey. the importance of starting as soon as possible. But then, well, what do I invest in? I don't exactly know what to invest in. There's thousands of opportunities, thousands of companies that I can invest in. Which one's good? Which one's bad? Well, let us help you here. Because a great approach that we feel, and this is something that I would say universally is an accepted method, is diversifying. You've all heard that term, don't put all of your eggs in one basket. Well, let's talk about what that really means. John Bogle, founder of Vanguard Group, and if anybody's ever heard of Vanguard, you'll understand that they're one of the largest asset managers in the world. They've popularized passive investing, by introducing solutions such as ETFs. John Bogle said, "Don't look for the needle in the haystack; just buy the haystack." Okay. Now, I didn't personally grow up on a farm, so maybe that haystack reference may not exactly connect with everyone here. But the idea is that rather than trying to pick and choose the right investment, why not just buy the whole lot, as they would say, right? And to kind of illustrate this point, what you're going to see here is something that looks like my daughter may have put together in class, but what it is the chart on the left basically shows you the different asset class returns from a period of 2017 until 2021. You'll notice on the very left-hand side, top left-hand side, you'll see this acronym. It says EM, and EM basically stands for emerging markets. Well, what this is telling you is that in 2017, emerging markets were the best performing asset class. They had a return of 37.8%. So if you were invested in a fund with a core focus of emerging markets, you would have been very happy that year. 37% return, spectacular. And had you been in cash, which is towards the bottom left, you would have had a nominal return of 0.8%. You wouldn't have even beaten inflation at that point in time. So technically, you would have had a net negative return. That would have been really disappointing. But you were really happy because you chose emerging markets. Well, let's say you wanted to repeat that success in 2018. So you took all that money and you continued to invest only in emerging markets in 2018. Well, in 2018, emerging markets were the worst performing asset class. They had a negative return of 14.3%. And cash that year was king. All the other investment vehicles that were available, whether it be real estate investment trusts, large cap stocks, small cap stocks, everything was in the negative territory, and cash was king that year. Well, you learned your lesson, you licked your wounds, and you said, okay, you know what? This year, I'm going to invest in both emerging markets and in cash. Surely, they were awesome the last couple of years. Lightning must strike 3 times, right? That's this point in time. Well, in 2019, large cap stocks, the likes of the Microsofts, the Googles, all the big boys that we know, all too well, were the best performing asset class at a return of 31.5%. Where was emerging markets? Middle of the pack, 18.9%. Very decent. It's an amazing return, but not the best. Cash, you're at 2.2% growth rate. So what this chart is trying to show you, there is a randomness to returns. You will not be able to pick an asset class and ride it to success for the entirety of your investment career. And some may say, well, I really believe in technology stocks. Yeah, there are periods of time where tech stocks doing amazing, but this year, where are tech stocks now? There are periods in time, and there's randomness to returns. Well, let's talk about maybe not necessarily sectors, but let's talk about countries. I want to just focus on the market performance of a particular country, which is highlighted by the chart on the right. In 2017, Austria was the best returning market. They had a return of 59%. In 2018, Finland had the best return at a negative 2.2% return. Who would have thought in 2020, Denmark would have had the best returning market on the international market? There is randomness associated when it comes to investing, and it's very difficult to predict accurately, especially on a repeat exercise. You might be able to get it right one year, but it's very difficult statistically to get it right year after year. So the best approach is to diversify. Instead of buying 1 or 2 asset classes or buying, buying into 1 or 2 different countries, invest in the basket itself. Have all the different asset classes represented in your portfolio. Have all the different international stock markets represented in your portfolio, because what it does at the end of the day is it reduces your overall risk, but it gives you an opportunity to benefit from the growth from the aggregate of all of these different asset classes and international markets. Now, the best way to do that, and we could thank the likes of John Bogle with this and many other proprietors all around the world, is investing in something called an exchange traded fund, or ETF for short. Probably you've heard about this. Everybody says it's synonymous with passive investing, and I would agree with that as well. Because what an ETF does allow you to do, it allows you to invest in many different sectors and many different geographic regions very easily in a very cost-effective way through one fund. One stock that basically allows you to buy multiple stocks just by investing in an ETF. So take case in point this particular ETF. It's IEFA. It's our developed market ETF that we actually use here at Sarwa. This particular ETF, assuming that you invested, let's just say $1, just as an example, this $1 will be spread all throughout the industrial sector, the technology sector, the healthcare sector, consumer discretionary, consumer staples, all the companies that operate in these sectors, you will be invested in on a fractional basis. In addition to that, this particular ETF gives you geographic coverage in developed markets. So the same, companies, whether it be in, materials or communication or maybe in IT, they're going to be operating in Japan, the United Kingdom, Switzerland, France, Germany, Australia, Netherlands, etc. An ETF, very simply, folks, is just a basket of securities. That basket that I was talking about, they've created it. It's an ETF. It has stocks, the bonds, you have your real estate, you have many different asset classes, all bundled up into one product. And what it allows you to do is it allows you to buy fractional shares and hundreds and up to thousands of companies through one product. It makes the work a lot easier for you. It makes it a lot more cost effective. And it's very easy to track and transparent because this is a live stock security. You can just go onto Google at any point in time and say, well, how is this ETF performing? It's just like any other stock. So it's an amazing invention, probably popularized over the last 30 years that you're seeing a lot of retail investors utilizing to help them achieve their financial goals. Now, how do we apply this at Sarwa? Well, as a Sarwa user, you will be recommended a portfolio of ETFs. We also, depending on your preferences, will make a recommendation to you whether a conventional portfolio is ideal, whether a socially responsible portfolio is ideal for you, or maybe a halal portfolio is ideal for you. Each and every one of these portfolios will give you exposure to US markets, to developed markets, to emerging markets. In some cases, for clients who want to dabble a little bit into cryptocurrency, we'll also give you access to cryptocurrencies in an advisory format in your portfolio. You'll have access to real estate, commodities, global bonds, you name it. We basically have created different portfolios to meet the needs of our client base. Now, passive investing is something that we strongly recommend here at Sarwa. We feel that the data points are very positive in the sense in that the historical returns of passive investing or tracking an index have been much more favorable for investors relative to actively managed investments, whether it be mutual funds or maybe trading yourself. Well, but then again, there are some people who just genuinely enjoy maybe trading or maybe enjoy actively managed investments, and that's okay. To that we say, take a strategy, take an approach in which you can have a bit of both. There's something called core and satellite strategy, okay, or a core and satellite approach. And what it essentially means is that the core of your portfolio, the amount of money that is needed for your goals, such as your retirement, again, education, savings, et cetera, the money that you just can't afford to lose is probably best invested in a passively managed manner through a use of ETFs that track major indices all around the world. Maybe consider, if you're still interested in trading or still interested in investing in actively managed funds, maybe having a smaller component, in this example called satellite portfolio, in which you can basically invest comfortably a percentage of your overall net worth that you're comfortable taking a risk on, that should something happen, where the performance doesn't meet your needs, or maybe you suffer a loss, it doesn't impact your financial goals. And as a really great way to think about it is, consider planet Earth. We have satellites basically orbiting all around planet Earth. Think about it from a scale perspective. A passively managed portfolio should ideally make up at least 80% of your overall portfolio value, and 20% could be satellite. That's good risk mitigation. That's good risk management. And that's a great way to approach it. Now, of course, at Sarwa, we offer both services. And for those of you who weren't aware, we give you the ability to invest in a passive manner. Everything is automated for you. We will take care of the rebalancing. We'll take care of the dividend reinvesting. We'll give you the recommendations. You have access to advisors, access to a great customer support team who's available from 9 a.m. until midnight. That's perfect for your core approach. That's Sarwa Invest. But if you want to get a little spicy, you want to try something on your own, DIY, that's where Sarwa Trade might be the ideal solution for you. You'll have access to over 4,000 stocks, basically that are domiciled in the U.S. So any U.S. company or international company that is listed on the U.S. exchange, you will have access to it through Sarwa Trade. You also have access to cryptocurrencies on there as well. In both cases, we have very favorable FX rates. You do not pay an international transfer fee to fund your account, nor do you pay an international transfer fee to redeem your investment accounts as well. So these are, great solutions and options that you have available to you. And that note, in summary, diversification is key to the longevity and health of your portfolio. If you would like to diversify further, consider a core and satellite approach. And in that case, Sarwa Invest and Sarwa Trade would be a perfect complement to each other to help you achieve your financial goals. On that note, I'm going to give it over to Akshay. I think I've spoken long enough. Maybe give everybody a little bit of a break from me. Akshay, it's all yours. Please do tell us how to lower our investment costs.
Amazing. Thank you very much, Eamon, and thanks for those first two rules. Very insightful. And for everyone else, thanks for submitting questions. Please continue to do so. We're going to be addressing those very shortly as well. Sorry about that. And yeah, so for me, I'm going to be covering rule number 3 and rule number 4. And rule number 3 is all about lowering your costs. So a really interesting fact that I think a lot of UAE residents should know is that the average UAE investor pays more than 3% per year in fees. And that's actually more than any developed country in the world. Fees is something that we are very passionate about at Sarwa because it is one of the few things that you can actually control as an investor. When you invest in capital markets, there are so many forces that are much larger than us that impact markets, whether that's social or political or economic, whatever it might be. But these things are much larger than us. So one of the things that you can control as an investor is your costs. The higher fees that you pay, the larger impact that this will have on your investment returns. And look, with any investment, you're going to find that there are always different types of investments, and they always have different fees that are associated with them. It's really important to know exactly what you're paying. And one thing that I always talk about with my clients is transparency and simplicity is the most important thing when it comes to fees. The investment provider that you work with, they should really be able to clearly illustrate your fees. And if there's any ambiguity, that's a really, honestly, a sign to steer clear. Transparency of investment fees is a huge problem in this region. And usually when you meet with a traditional financial advisor, from first appearances, everything seems super cheap and clear. A lot of companies often advertise, free or bare minimum fees. But when you actually look under the bonnet, there are, a bunch of different fees that are associated. And all of these fees are written in the small print. A lot of these, financial salespeople are incentivized by commissions. And the main goal is to sell a product, gain a commission, and then move on to the next person. And for a lot of us in the UAE, a lot of people actually have been burnt in the past by this. And that's what's really important, to always try and work with a fee-based firm because their interests are actually aligned with yours as a client.
When you say fee-based firm, actually, can you elaborate on this, what that means?
Yeah, of course. So historically in the financial advisory sphere, there's always been two ways to approach it, either commission-based or fee-based. And so commission-based is often when, let's say a financial firm will sell you a product and then you'll pay them commissions. And then there's no more responsibility on their end. They paid you paid the commissions, they kind of move on and then continue to sell a product. A fee-based firm is where you actually have, an annual fee as part of your investment product. The reason why that's very important is because it actually makes your interest aligned with the advisory firm. So the more that your portfolio grows, the more that the advisory firm is compensated in the sense where obviously with the percentage amount, And so that gives the advisory firm an incentive to keep you satisfied as a client, to keep you,
Mm,
existing as a client, and to also try and obviously help you with those goals and objectives. It's something, commission-based advice in certain markets, such as the UK, is actually banned when it comes from product providers. So, in this part of the world, regulation and financial regulation is a little bit behind. But that's really where hopefully it comes to at a certain point where the regulators will kind of step in to make sure that commission-based advice is at least more moderated. So, but whilst that's not the case, it's really important to always look out for these things as an investor.
Yeah, and you can see a case where, let's just say, one product pays a better commission than another product, and maybe that advisor will be incentivized more to sell that particular product, even though it's not suitable for the client. And that's where the disconnect is, right? Between the client's needs and what the advisory firm or the advisor wants to basically sell. And I guess when you go the fee-based approach, it's neutral. It's black and white. I'm incentivized
Yep.
just to maintain your relationships. I'm going to give you great service. I'm going to give you great advice. The product that you choose is independent of the service that I'm going to provide you and independent of the fees that I'm going to charge you, which I feel like it's a much more transparent way to operate.
Yeah, 100%. That's exactly correct.
Awesome. Thanks for that.
Yeah, of course. So look, over here on this slide, we, try to get into some hypotheticals. And over here, there's this scenario that paints a picture of the importance of investment costs. Investment costs might not seem like a huge deal, when we're looking at such small percentages, but they actually add up. They compound along with those investment returns. So you're not just losing the tiny amount of fees that you pay, but you also lose all the growth that your money might have had for years into the future. So very simple example, if we look on the bar on the left, imagine you've invested $10,000. If that account earns 7% a year for the next 30 years, compounding over time and had absolutely no costs and no fees. By the end of that, you will end up with $76,000 in earnings. This assumes absolutely no future contributions either. And look, this is a perfect world scenario. I'd be very happy with that. I'm sure everyone else would be very happy with that. But unfortunately, that doesn't necessarily exist, and you always do have to pay something. But let's use 1% in this example. The bar just right over from it. That's very realistic. If you invest the same 10,000, the account earned the same 7% for the next 30 years, you'd end up with 57,500. I think that's a very good benchmark. That's also a very impressive gain. I'd be very happy with that too. A stark comparison is if we look at the bar all the way on the right. This illustrates if you pay 4.5% in fees. And whilst this might seem extremely unreasonable, it is actually something that's very common, especially in the UAE. And the reason for that is, look, people are not aware that they're paying 4.5% in fees. It's what I said before, these things are often written in small print. The fees are not always disclosed. There's different, commissions and things that are associated with it, but it does happen. So if you invested that same 10K, after 30 years, you'd only have around $21,000. So you will have paid 55,000 just in fees. And in this scenario, you're actually forfeiting over 50% of your profits to fees. And like that's huge. If that's happening to you, you'd hope that advisor who's charging you 4.5% in fees is, driving you to work, washing your cars, picking your kids up from school. Like the list can continue. It's super important. If that's happening, you want to be getting some more out of it, right?
It's astounding because it's like the numbers, they don't seem that different. It's like, oh, the difference between 1% and 2%, 2% to 4.5%, but it matters. It really matters over the long term.
Yeah, year after year after year, it's the same as when your investment returns compound on themselves, the same as what fees does in the opposite direction. So it makes a huge difference. And look, finally, I wanted to show everyone on the call a very simple fee comparison between Sarwa and a lot of the traditional investment solutions in the marketplace. I've been fortunate enough, or not fortunate enough, depending on who you asked, to have had the opportunity to work in traditional banking, private wealth management also. So I'm very familiar with the fees that are levied by both. And I can safely say that in comparison to these investment solutions, Sarwa really does provide more flexibility, transparency, and overall costs, than a lot of other firms out there. Kind of in this day and age, and truthfully, you want to have your investments to be as flexible and accessible as a bank account. And that's why, we're big fans of not, penalizing you for exiting or withdrawing or anything like that. Very simply put, if we compare, Sarwa with, let's say, the most traditional financial advisors that we have in the region, we don't have any entry or exit costs. We don't have, basically any commissions that we pay to the advisory firms. There's absolutely no, withdrawal penalties. And also we actually have commission-free products. So where it could be the independent company, we're not tied to any product provider or to any investment solution whatsoever. And unfortunately, with traditional financial advisors, there often are these exit and entry costs. There are commissions to advisors. There's withdrawal penalties and surrender penalties, and often basic commission products as well. So that's a very, kind of big difference. It's what you want to be looking out for as well. And look, just in summary for everything fee related, I'll leave you with 3 things. Number 1 is look for transparency and make sure you understand exactly what you're paying for. Number 2, if you are paying for advice, ensure that you're actually receiving a high level of service for that advice, and try to use 1% as a fee benchmark for your overall costs, or lower if you can. And yeah, that's it in regards to rule number 3. And so moving on to rule number 4, which is the final rule, and it's all about managing your expectations. And I think this is a really great section, especially important right now when markets are relatively volatile. And that's why it's really important, when you are investing, to not let your emotions cloud your judgment. This is a quote by Peter Lynch. Peter Lynch is somebody who managed the Magellan Fund at Fidelity. He is a huge proponent of value investing. And I think this quote actually speaks volumes of truth at this point in time. So it's far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. This really reemphasizes the importance of not trying to time the market and speculate on the market. If we go to the next slide, this is a perfect illustration of what most investors go through. It's one of my favorite sort of illustrations that I've seen. It's something that we use with our clients constantly, and it's something that we're going through right now. So, in investing, we all invest based on emotion, and there's 2 things. There's always fear and greed that are the 2 biggest factors in investing. These are the reasons why people either buy or why they sell. And unfortunately, a lot of people tend to buy when markets are high and sell when markets are low. In an ideal world, you want to be doing the opposite, buying low, selling high. I'm sure you've all heard it before. And, very often, you hear in the media or from your friends, certain stock is performing extremely well. You hear about your Apples and your Teslas, your Amazons. And then by the time you buy it as an investor, the stock has reached an all-time high. And you've actually entered the market at what's called a point of maximum financial risk. And that's when we're often tempted to buy more. But then as normal economic cycles go, as normal business cycles go, markets fall and we start to question our decisions. As an investor, you might enter into a sense of denial. That denial turns into panic. And then in panic, a lot of people end up selling their investments and then they realize a loss. But actually, at this point in time, when the market's very low, it's actually what's called a point of maximum financial opportunity. So I'm going to use an example that we love at Sarwa. If you've been eyeing, a pair of sunglasses or a bag in a store, suddenly you go into that store, you see that the bag, sunglasses on discount. You're not going to wait around for the price of that to go back to normal. You're going to buy the item on a discount. And then I think that's a really good way to think about your investments. And I know it's easier said than done. Our emotions can get the better of us. We are humans at the end of the day. But in reality, it's almost impossible to consistently predict markets. And that's why it's really important to have a financial plan in place and just ride the wave. And regardless of if the market is going up or down, don't worry about short-term volatility, because when we look at history, we can see, the benefits of long-term investing. And this slide is actually taken by a study from Morningstar called the Mind the Gap study, which measures how investors' actual results stack up compared with total investment fund returns. So firstly, I'll distinguish that the bar on the left is investment returns, which represents a simple buy and hold strategy of certain assets. The investor returns bar on the right represents actual investors, such as me or you, who were invested in the same assets as the bar on the left, but had the opportunity to buy and sell at different moments based on trying to time the market. So the behavior gap, that little line that you see over there, stems from poorly timed purchases and sales of the shares. So that actually costs investors nearly 1/6 of the return when they actually would have earned if they just stood still and held the assets. This study is conducted on a yearly basis. Each year they find that investment returns always outperform investor returns, because trying to time the market and outperform the market on a consistent basis is actually impossible. Investors often, they don't stay the course, their emotions take over. But in reality, if you just leave the funds alone, stick to the plan, that's when you reap the reward.
You took the words right out of my mouth. I was just gonna say, actually, so we just do nothing, like just literally do nothing, and it'll just sort itself out. And this is what the study basically highlighted, right? That the investments themselves did better than the investors because investors just didn't leave it alone.
Exactly. I say this to clients all the time. I know it seems like the most counterintuitive thing that you could be doing, do nothing, but in reality, it's one of the best things that you can be doing. So yeah, just moving over to the next slide over here, I just wanted to quickly talk about 3 reasons why people act on impulse when investing and what you can do about this. So number 1, if we go to the next slide, it's that they always fail to filter the important information. And that's why it's really important to silence the noise. There's always going to be external factors that are larger than us that are impacting the markets in all sorts of directions. What you can do as an investor is focus on why you started investing. Focus on your financial goals. Make sure that you have an investment strategy in place and try your best to stick with it. Try to disregard what's happening at the moment, the news, the media, because by the time you actually need the money, you're not even going to remember what happened, 10 years ago. With number 2, a lot of people invest with no clear plan. And I think this slide really highlights the importance of financial planning and the simple steps that you can take with your personal finances to ensure that you don't ever need to be concerned about market volatility. It's really important that when you invest to always have that goal or objective in mind. Because if you establish these things, you actually are able to understand your attitude to risk and your time horizon much better. It's really easy to block out the noise because you'll have that investment plan regardless of how the market's performing, in the interim or whatever it might be. I think a really good place to start is to ask yourself the questions, these 5 big questions. How much can you save? How much will you need? What do you want to leave? How much risk can you take and when you're going to need it? What I'd always suggest is, speak with advisors, such as Eamon or myself. Speak with your family, speak with your friends. By speaking with more people about these things, you can help yourself identify the goals, and then you can set yourself up with a financial plan. I'm a very firm believer, that everyone should have a financial plan, and historically, financial planning is something that's been accessible only to wealthy individuals. At Sarwa, we really believe in breaking down those barriers. We want to give you guidance on where you are right now, where you want to be in the future, and exactly how you can get there. And finally, number 3 is a lot of people fail to see the bigger picture. And this little illustration is honestly one of my favorites because I think often when people invest, they're constantly focused on what's going on in the markets and how their portfolio is performing in the short term. But what a lot of people forget to do is to take a minute, zoom out, see how the portfolio or the market's been performing over the long term. Short-term volatility is part and parcel of investing. If anyone's on the call that it's a beginner investor, I will tell you now, it's very normal. You're going to experience it for the years to come. The market's going to be up, it's going to be down. But as I said again, when Eamon even mentioned, all about risk. When you zoom out, when you see how markets have been performing over the past 100 years, we see time and time again, they rebound and they perform extremely well over the long run. I think as long as there's, continued human ingenuity, technological ingenuity, we're going to prosper, we're going to see markets perform well. And that's why it's important to stay invested for the long run to reap that reward. And finally, I'm going to leave you with these 6 things. So take a breath, don't panic, block out the noise, invest with a clear plan, try to stop checking your portfolio, revisit your plan, and try to speak with a financial advisor if you can. If you don't need that money in the short term, as I said before, don't worry what's happening in the short term. And finally, there's a quote that we love at Sarwa. It's investing is like a bar of soap. The more you handle it, the smaller it gets. And this is going back, what we said before. It seems counterintuitive, but often doing nothing is one of the best things that you can do as an investor when things are rocky.
Amazing. Thank you for that, Akshay. Look, we're at the end of the webinar right now, and we just wanted to finish it off just to highlight how we apply these 4 rules here at Sarwa through the services that we provide you. These 4 rules are not just best practices, but also there's applications to these best practices themselves. When we talk about starting now, we made sure to remove the barriers to entry for our investors. So, our minimums to start investing are quite low relative to many of the other financial advisory firms within this region or banks. where in our Sarwa Invest portfolios, you can invest for as little as $5 to get the journey started. Even with Sarwa Trade, if you want to be, behind the driver's wheel and start picking your own stocks, you can invest as little as $1 in order to start investing. Our entire service, offering is digital and online, meaning that, as I said, from the comfort of your living room or wherever you might be, wherever there's internet, you can register and open an account, and you can view your portfolio every single day. You can trade in the evening when the markets are open. This is one of the benefits of technology that allows us to make things more convenient, much more affordable, and also much more accessible for you as an investor. Number two, diversification. This is a key rule that we talked about. We apply this here at Sarwa, where if you're investing in our Sarwa Invest portfolios, you'll have access to 6 different ETFs covering the globe, many different asset classes, many different countries to allow you to diversify in a very effective manner. And if you're looking to trade, the Sarwa Trade gives you access to over 4,000 companies that are listed in the US exchanges. This is a great way to be able to approach that diversification need.
Perfect. Yeah. And for rule number 3 and lowering your costs, our fees actually operate on a sliding scale for Sarwa Invest of 0.5% to 0.85% per year, depending on how much you have invested. With Sarwa Trade, it's actually free of costs, so no commissions whatsoever. And that's actually the only fee that you pay to Sarwa when it comes to the Sarwa Invest. It's just the annual management fee. Absolutely no commissions, no exit fees, no trading fees, no brokerage fees, and that's it. And with rule number 4 and managing your expectations, so we actually have automated investments that take the emotions out of investing. This includes investment rebalancing, so you as a client don't need to do anything but deposit funds. So it's really the definition of autopilot investing. And very importantly, we've got an amazing customer excellence team, we've got an advisory team, and we'd love to speak with you. So that's one of my favorite parts of the job. So if you ever have any questions, concerns, always reach out.
Amazing. And that brings us to our Q&A section. Thank you, everyone, for being so patient and waiting until now. Let's take a look. Let's jump in to see what the questions are. And what I need to do is stop sharing first and jump into the Q&A section.
Yeah, I've got one. Yeah, over here, we've got a question. When can I stop funding my retirement portfolio and start to take profit, even if it's small, as part of my monthly income? Yeah, that's a good question. And I think, the answer to that, it's always going to depend on what your individual circumstances are. And that's why I would definitely recommend, to maybe try and book a call with an advisor, because it's really important to understand, exactly what your retirement goals are and how much you need to take when it comes to retirement. Everyone's going to have different goals and objectives. Some people might be able to live off, a few $1,000s a month. Some people might need, tens of thousands of dollars a month. So it's really going to depend on those sort of goals that you might have. But often what we'd always try to recommend is, the longer that you can have your money invested, the more, obviously, as we've seen before, the more sort of profit you will generate in the long run. So if you can, potentially delay that and try to avoid taking profit too often, your money's going to be able to compound over itself, and then you're going to end up in a better position in the future.
Yeah, absolutely. I mean, the ultimate goal at the end of the day is a lot of people are looking for passive income, right? You're saving for a purpose, and that is to enjoy a quality of life or to acquire, something, with that money at the end of the day. And one of the great reads, that we'd be more than happy to share with you, is a 4% rule, right? And think of it this way: assume that you've built up a portfolio of $1 million US, just hypothetical. If you were to generate a level of income, whether it be from dividends or maybe some capital withdrawals that equate to 4% per year, that's $40,000 in passive income that you'll have year after year. That could potentially let this fund continue to run, but you can withdraw more, maybe 5% of your portfolio, 6% of your portfolio, maybe 10% of your portfolio. Whatever your requirements are for passive income, the world's your oyster. You have a portfolio that you've built up. Now, when you're at the early juncture of your investment career, you don't have $1 million. You're trying to aspire to have $1 million. So you're building it up over time. You're reinvesting your dividends instead of withdrawing it. You're making sure that every opportunity that is available to you to contribute towards your investment, you're taking it. And that's why you're trying to get to that pot. And when you get to that pot, okay, maybe now I can start living off of this pot. I'll have that passive income, or maybe I'll withdraw it all, or maybe I'll withdraw partial, or maybe I might just take this and buy a a beautiful home that I had in mind, and my expenses are going to be minimal. Whatever it might be, the idea is that you want to build it so that you have enough to live off of. Hope that answers your question, Anonymous. Ali has a question as well too. It said, how much should I have in emergency funds?
Yeah, very good question, Ali. So in regards to emergency funds, we talked about a little bit before. Best practices, a lot of people say 3 to 6 months worth of expenses. So I think that can be a really good principle to follow.
Yeah, absolutely, absolutely. And depending, and it's very subjective as well, because we give you that range of 3 to 6 months. Because think of there's some careers that are much more employable than others, right? And it's just a fact of life. Some certain jobs will take a little bit longer for you to find another, and certain jobs you'll be able to find rather quickly. And a good way to kind of approach that is that maybe you want to take a more conservative approach and have upwards of 6 months. But if you feel that your employment opportunities are going to be considerable, that there's going to be a lot of opportunities to replace your income, maybe 3 months might be more than enough. So it is very subjective. For example, my home country is Canada. My parents are there, my brother is there, my sister is there. I know that if things take a turn for the worst, I have a couch I can lie down on, right? I have a bed that I can stay in. I have a room that I can stay in with my parents. So my requirements are much less there. Whereas as an expat here in the UAE, where I may not have those resources available to me, so I should have a little bit more cushion to buy me time to be able to replace my income should I lose my job, for example.
Yeah, I'll also just add to that. Another big thing is, you've got your emergency reserve, but it's also important to have a budget in mind. So normally we recommend, if you have any big expenses coming up in the near future normally means within the next year. We often say that it's good to keep that money aside in sort of emergency as well. Maybe you're looking to buy a house, or maybe you're looking to buy a car. It's important maybe not to invest that amount of money initially, because if you invest it straight away and you need that money, that's in the next year, it's going to be subject to market volatility. So, always have your emergency reserve, but then also think about your overall budget as well.
Absolutely. There's a question here from Lakshmi, said, are ETFs like mutual funds? Very close, I would say. I mean, as far as the look and feel of it, they're very close. And I would say mutual funds have been very popular investment solution for many years. They were in fact probably the initial investment solution available to retail investors. Prior to, I would say, probably early 70s, don't quote me on the exact time, I would say probably 70, 71. If you were looking to invest, you had to basically have a high-powered stockbroker, invest your money, to which you needed a large capital base just to even qualify to speak to a broker. Retail investors were basically shut out. And the invention of a mutual fund allowed individuals to be able to invest in a diverse manner. This is early 70s, and the structure of mutual funds haven't changed much since then. What's happened, in fact, is that the expense ratios of these mutual funds have unfortunately gone up, and you're paying the expense for it as a retail investor. Technology has improved, solutions have improved, ingenuity has improved, and that's what gave birth to ETFs, where it's the same idea. You have a basket of different funds, except the approach is slightly different. A mutual fund will have a portfolio manager and a portfolio management team who is making active decisions in order to try to generate alpha, or trying to generate returns that beat the market. That means that they'll need to basically buy and sell securities within your portfolio. Their pool of the number of securities within that mutual fund are typically limited in comparison to an ETF, because they can't keep track of thousands of companies on any given day. So typically you might have 70 to maybe 80 different companies operating within that mutual fund. Their compensation is directly tied to the performance of the mutual fund. So there's an incentive for them to take more risk to generate an outsized return, so that they can get compensated handsomely. Well, this is your money, folks. And sometimes that risk that they're taking with your money can unfortunately go in the wrong direction. And historically, it's been shown that actively managed investments like mutual funds, in comparison to passively managed investments like ETFs, they have not performed as well as ETFs. ETFs themselves, or passive investment strategy, has generally done better than actively managed investments altogether. And that's because there's beauty in the strategy of an ETF. An ETF takes the premise that we can't predict the market. There's no way I can game it, but what I do believe is that over the long term, that markets will appreciate in value. So what I'm going to do as a portfolio manager is basically spread my risk, invest in the entirety of the market, and just let it sit and wait and let it grow with the market. What this allows the portfolio manager to do is reduce their overall expenses. It allows them to reduce their research, their trading costs, their personnel overhead. It reduces that cost, which they pass on to you in savings. So a typical mutual fund will charge you maybe 1.5% to 2% per annum just for the privilege of holding that mutual fund, whereas an ETF, I mean, take for example the ones that we have in our conventional portfolio, the average expense ratio is 0.06% minimal. Big difference between the two. Hope that answers your question, Lakshmi. All right.
Awesome.
What else we've got here, actually?
Got another question from Lakshmi about does Sarwa allow FX and commodities trading? So no, actually, we don't actually have the ability to trade FX and commodities on the Sarwa platform. One of the big reasons, at least for commodities, is when you trade commodities, you need to actually trade on what's called a derivatives exchange. And normally the ticket sizes for those investments are quite high. You're looking at, tens of thousands of dollars usually for legitimate commodity trading that's on derivative exchanges. And it's kind of similar with FX. We don't actually have the ability to trade it in FX. Look, I think it's something that we would potentially look to do in the future, but at this point in time, it isn't.
What I'm going to do is, I know we're over time, and I apologize to those folks who've been with us all this time. And for those who unfortunately have to, drop off, this session is recorded, and you will get a copy of it. What we're going to do is we're going to start running down the questions. So I'm going to jump to other questions here from other individuals. So yeah. Paolo has asked, will regarding the available stocks and ETFs on Sarwa Trade, will we see stocks that are listed in the UAE? It's a great question, Paolo. So as far as direct access to local companies that are listed on the DFM and ADX, we do not have access to that on the Sarwa Trade. However, you do have indirect access to emerging markets, of which it includes KSA, it includes companies in the UAE, through the ETFs, because we have an emerging market ETF as part of your portfolio. So you'll see the breakdown, you'll see your Brazil, you'll see your India, you're also going to see your KSA, you're also going to see the UAE in there. So any of these listed companies that you are hearing about, they're going for IPO and eventually are going to be basically the mainstream, they will be included indirectly in your portfolio under the emerging market ETF.
Awesome. Got a question here by Sumit. She's asking, I'm a long-term investor for US stock markets. Should I invest all the money now in one go, or in different phases, or wait for some more time? Really good question. I think the big thing about that is it's a lump sum investment versus a dollar cost averaging investment. So when you basically do a systematic investment plan. So Sumit, historically, if we look at it purely from a data standpoint, the best results when you invest are from a lump sum investment, if you're doing investing for the long term as you are. However, with that being said, there's a lot of advantages with dollar cost averaging or investing in phases. And, if you potentially might be dissuaded by when you see the portfolio dip, or you're concerned when you see market volatility, I think purely for a psychological standpoint, the investing in phases is actually a really good option. But if we're looking at it purely from a data standpoint, as I said before, lump sum investing outperforms dollar cost averaging investing about 67% of the time. And then you asked the third kind of question is, should you wait for some more time? This I would advise against, and it's all about rule number one. It's all about starting now, yesterday, if possible. It's, to wait for some time is very, very difficult because you don't really know what you're waiting for. Us as retail investors, by the time if a lot of people, you're waiting for the bottom, you're waiting for the bottom of the market. By the time the markets hit the bottom, it's already on its way back up. And even, the top hedge fund professionals in the world find it difficult to know exactly, when that time to wait is. If you're a long-term investor, as you've clearly said, the best thing to do, I would say, is either do the lump sum investment where you invest everything at one go, or do it in phases. It's whatever you're comfortable with. That's what's, I think for budgeting purposes, and also for a really nice way to unemotionally invest in the market, phases is actually a really good way to do it as well.
Thanks. Akshay. We've got a question here by Rami. He said, "Is the advisory fee paid annually, or is it one time when the money is deposited?" That's a great question, Rami. So the advisory fee, being 0.85% for anyone who's invested between $2,500 and $50,000. Anybody who's invested between $50,000 and $100,000, the advisory fee is 0.70%. And anybody who's invested above $100,000, the fee is 0.50%. As Akshay mentioned before, it's a sliding scale, so the fee goes down as your deposit balances or your portfolio value basically increases. This fee is not charged up front, and it's not charged annually. It's actually, you pay for it on the monthly basis on pro rata. So if there's 30 days in a given month, you've paid for 30 days worth of service. If you've been with us for 6 months, you've paid for 6 months worth of service. So it is pro rata, and it's calculated based down to the day or the number of days that you've been with us. So at least that way, you're not paying upfront for a service you haven't received. It's pay as you go.
Awesome, thank you. Got another question, anonymous. Why don't you take options, the assets like gold and gas and forex? So very similar to how I answered before. So kind of covered that already. Perfect. And Zahid is asking, can you help us understand, is it useful to invest in crypto? Zahid, look, really good question. I think with cryptocurrencies at the moment, I would always go on the side of the core and satellite approach with something like crypto and more speculative assets. So crypto investing can be very useful for some people. However, cryptocurrencies as an asset class are still quite a new asset class. And there isn't, a significant amount of fundamentals behind them at this point in time. So normally with that comes a lot more volatility. Volatility is good. It's actually a huge opportunity for a lot of people. But be mindful that when you are investing in crypto assets, understand what your capacity for, your capacity for losses and your attitude to risk is. It's all very well and good to invest in crypto, but you always also want to make sure that I would advise you to do it in the core and satellite approach. Have the bulk of your portfolio in something more passive like Sarwa Invest. And then, maybe that remaining 20%, you can be more speculative with it, if it's stock trading or crypto trading. And I think that's the best way to do it.
There's a great question here by Anonymous, is that if we set our profile based on risk level, and then later we think about changing it, maybe going from conservative to more risky, or maybe vice versa. Can you adjust it? How often can you adjust it? So the answer to that, Anonymous, is that yes, you can adjust your risk profile on your Sarwa portfolio at any point in time. In fact, we provide you the functionality to do that on your app or on your desktop, on your computer. There's a button that basically you click it. It's an edit button and allows you to change your risk profile. And what that will do on the back end is basically we will adjust your allocations according to the risk profile that you've chosen. So let's take, for an example, you started your portfolio on a 50-50 approach. And what that means is 50% are in bonds and 50% are in stocks. Suppose you wanted to take a higher level of risk, maybe one step up. That would be in our books a 62% exposure to equities and 38% exposure to fixed income. What we would do in this case is that we would sell your bonds in favor of buying more stocks. So we will sell your fixed income, and that same money that's from your fixed income, we will buy more stocks, which means your allocations will adjust accordingly. You'll be more heavier weight. You can also do the reverse. Now, Anonymous, I'm going to say, this is really important. It is not recommended to change your risk profile constantly back and forth, because what you're essentially doing at that point in time is you're trying to time the market. And you're trying to time the market based on stale news and what's already happened in the market. So take, for example, you're in a portfolio where it's 94% stocks and 6% equity. You watch the news, it's the evening now, Sarwa's closed, our office hours are done at that point in time, and you see that the market is on a downward trail. You're seeing that the S&P is down 1%, 1.5%. You panic and you say, reduce my risk profile. You know what will happen on the back end is that we're going to sell your stocks in favor of buying more bonds, but the stocks are already down. You're watching the S&P basically taking a downward trend, which means that you're solidifying your losses. You're selling at a loss, which is not what you want to do. The best strategy to take is determine what your goals are, choose the appropriate risk profile to which we give you a recommendation for anyways, and maintain that trajectory unless your financial circumstances have changed. And that's when it's a good time to have a conversation with someone, a professional who can better advise you on what the appropriate risk profile to take. Maybe we should just take one more question, Sarwa. Sorry, Sarwa. Akshay, you say
Yeah,
Sarwa so many times.
Yeah, of course. Got a quick one. Ramiz is asking, is Sarwa, are the dividends paid out or reinvested? With our Sarwa Invest portfolio, the dividends are reinvested, so it's nothing for you to worry about. And then with Sarwa Trade, you will get the dividends paid out into your cash account, and you can choose to do whatever you want with them.
Amazing. Ladies and gentlemen, thank you so much for sticking around. It has been a pleasure for us. This is one of our favorite activities to do here at Sarwa. We encourage you to, if you haven't downloaded the app as yet, please do download it. If you're more of a desktop person like myself, I love looking at my portfolio on the desktop. Please have a look at it. If you have any questions at all, don't hesitate to reach out to our customer support team, or if you'd like to speak to any one of our advisors, just reach out to us again once more, and we'll make sure we set you up for an appointment via video or via phone, and we'll walk you through. We wish you the best of health and the best of financial success, and thank you for joining us this evening. Have a wonderful evening.
Thank you, everyone. Take care.